The broadcast is now starting. All attendees are in listen-only mode.
Hey everyone, this is Mitch Piper, National Membership Director here at ASCPS, and welcome to what is going to be a very interesting conversation about contingency fees, even maybe a little controversial for some people that have been emailing me the last couple of days since they heard about the webinar. But I assure you that Bill is definitely an expert in tax resolution, and I'm sure he's going to give you guys some great advice. But before I get started, I just want to cover a few things that you need to know about the webinar, housekeeping types of things here. So the first thing is, if you would like to download the slides and you haven't done so already from the email that I sent out earlier, you can, in the GoToWebinar chat or panel there, there'll be a handout section. You can just click on that and download it. If you'd like to ask any questions throughout the presentation, you can type them right into the chat box. And I believe we're going to have some time for some questions at the end. So we'll try to go through as many of those as we can. The certificates, we will send out, as long as you're in here for 50 minutes, we will send you a certificate probably on Monday that you can download for your records. If you're an EA, we will report everything directly to the IRS for you. And I just like to take this opportunity to please let you know to download the certificates when you get them. And maybe even a good idea to keep a binder or something like that around that you can put all the handouts and certificates in so you can keep them. That would definitely help us out if you don't have to just call us and have us resend you 20 of them at once. So that we'd appreciate that for sure. And then there's going to be 3 polling questions. You got to answer those. And then unfortunately, if you are listening to this on the phone and you're not logged in onto the computer, then unfortunately the program doesn't give us a way to track that you are paying attention, and so we can't give you credit for that. So you have to be logged in on the computer. But other than that, I won't take up any more time. Bill, if you're ready, you can get started.
All righty. This is Bill Nemeth. Welcome to a very controversial topic, contingency fees. I have done more reading about Circular 230 and some of the ruminations of Karen Hawkins and so on in the past 2 weeks than I care to talk about. Just want to tell you a little bit of history on Circular 230. It goes all the way back to 1884, the Horse Act. It is under Treasury Section 31 of the U.S. Code, Section 330. It regulates the practice of representatives of persons before the Department of the Treasury. Tells us, if you will, how we are supposed to do our job. But be aware, in 1884, there was no Internal Revenue Service. It came about in 1913 as a result of the amendment. I guess it was the 16th Amendment that was passed. There then came some questions. Okay, we now have these people that are authorized by the IRS. What are their duties and responsibilities? So Circular 230 was published in 1921 to define the ethical duties and responsibilities of representatives. Circular 230 just had its 3-year birthday back in June. It's absolutely severely out of date, and let me comment a little bit on this presentation. I could give the presentation in 2 minutes by saying the IRS does not approve of contingency fees except where they have lost in court. That's kind of the answer. And so we're going to be going through some of that history. We're going to be talking about Ridgely v. Liu, which is a case the IRS lost a few years ago that said IRS does not have complete control over our business models and so on. And that's the net of it. I just listened to the new OPR director, Steve Whitlock, last week. He had a 2-hour webinar. He's the new guy in town. He took over from Karen Hawkins. He is a longtime IRS staffer. He's held a number of positions. And he talked for 2 hours about how the IRS is going to crush us and penalize us if we don't follow the rules. On Saturdays, I happen to teach a course on people trying to become enrolled agents, and I told them about the webinar and shared with them, if you look at it in perspective, here we are. You're trying to become an enrolled agent licensed by the IRS to do good work, and now we have the head of the group that licenses you and they're threatening you with all sorts of things if you don't follow their rules. It just seems so odd. So with that, we'll kind of go forward. Circular 230 is way overdue for a rewrite, and we'll go through some of the reasons. Severely out of date right now, RTRPs, which stopped being in existence as a result of a Loving case, they're still in Circular 230. There is no mention in Circular 230 of the annual filing season program. That's kind of the gold star program the IRS created, completely voluntary. If people choose to be AFSPs, notice how that rolls off the tongue, they can, in fact, if the year they did a return, they're AFSP, and furthermore, if that return is pulled for examination and they're an AFSP in the year of examination, they can defend the return before the IRS. They cannot be involved in collection activities. And the last thing is there is obviously no mention of contingency fees that can or can't be charged under 10.27b. It does not mention Ridgely v. Liu. Liu was obviously the Secretary of the Treasury. Just wanted to play around with words a little bit. I thought, when I'm doing this, let's look at what Wikipedia would say for contingency fees. And this is their definition. They focus on lawyer services and basically a fee charge for a lawyer services only if the lawsuit is successful or is favorably settled out of court. Contingency fees for a lawyer are usually calculated as a percentage of the client's net recovery. And we all know about personal injury attorneys. I have a couple of them. Some years they make $1 gazillion, and some years they lose $50,000 because none of their stuff ever hit. So it's hit and miss. That's how those guys live and breathe. But more importantly, we really want to see how Circular 230 defines contingency fees. Their definition, and they went on for 5 paragraphs. I tried to distill it as best I can. Contingency fee is any fee based on the percentage of taxes saved or having a position that otherwise depends on a specific result attained. In other words, if I do this for you and I'm successful, you then will pay me this much money, or however it works. IRS takes it one step further, says refunding fees if the claim is not accepted, not permitted as well. We all hear those late night TV commercials that say, we will fix your tax problems. Notice none of them say money back guarantee. They would invoke the ire of the IRS. Great marketing program, but in fact, the laissez-faire Stephen Smith economics is not alive and well at the IRS. They don't want us to be marketing oriented and try to pull people into our business model. No contingency fees. And while we're on that, this one always amused me, unconscionable fees. There is no precise definition of unconscionable, but it's really, really, really high. And I'm in tax practice. I do returns. I get returns that other people have done, and you'll see how much they charge. And unconscionable is a state of mind. If you've got somebody working out of their house with no overhead, they may charge $50 for a normal 1040, married filing jointly with kids, and a house. And I have seen other practitioners who have fancy offices and staff and all of the amenities charging $1,000 or more for the same return. Now, is a $1,000 guy charging an unconscionable fee? I don't think so. He's just pricing it to where his business model works. And notice at the end of the day, there is no precise definition. The only place that you're going to see it is in a court of law. That's who will determine if something is unconscionable. Wanted to share with you one that we actually did a couple years ago, and this one is interesting. If, pretend I could do contingency fee. Here's what we did. We couldn't get wage and income because they were too old. We actually had to do a FOIA on the SFRs so that we could get wage and income. And when we did real returns for 1, 2, and 3. We did the 11 missing returns in between 2004 to 2014. As a result of our efforts, the client received $300,000 in refunds from an IRS levy that happened in the past 2 years. And he got that money back because of 26 USC code 6511. Wouldn't that have been fun to say, okay, the returns were not $300 a year, but really I wanted to get 10% of what I recovered. Obviously we didn't do that, but boy, it sure was tempting. Net, unconscionable fee. They usually end up in a court of law because they are subjective. They are not objective. And the more I think about this, the more I think, okay, if you go to somebody and they have a problem, you say, this is what I'm going to charge you. It's kind of a take it or leave it. Where it comes into play is when you're preying on people that are typically a confused state of mind. Think elderly people in a state where they're going into Alzheimer's and so on. In that case, it probably is easy to hit somebody with an unconscionable fee. And I personally think that that's really what the IRS is defending or is looking to chastise us for. If we really take advantage of a situation where you have a client that is not in full control of his mental facilities. Let's talk about then 10.27 B2.1 contingent fees. A practitioner may not charge a contingent fee for an original tax return. That is relatively recent. That is only 18 years old, believe it or not. Contingent fee, obviously, on an original return is a percent of the refund. I've had to do some CP 2000s and some audits on some returns that were done in Miami. In Miami, apparently, the normal way you get paid is to do a bank product, and you actually are paid on a percent of the refund. And in fact, these all bounced after the IRS looked at them because, as the taxpayer said, the gal finished the return, the refund wasn't big enough for her to take her cut, so she said, okay, which one of you two went to school last year? I have to bump up your refund $2,500 so that I can get paid appropriately. The IRS obviously brought their letters to bear 2 years later, and they paid back all of that, plus penalties and interest. Here is the one that is the heart of Ridgely v. Liu. Practitioner may not charge a contingent fee for an amended return unless the amended return was filed within 120 days of the taxpayer receiving a written notice of the examination of or written challenge to the original return. That is the basis for Ridgely. Ridgely was a CPA. He said, the IRS should not have the ability to affect my business model if I get a new client and I see that a prior year return that is still within refund statute can be amended. I want the ability of doing it on contingency. And the contingency may be, if you get your refund, sir, you're going to pay me $450 or whatever the number is. But true definition of contingent. He wasn't saying, I want 20% of your refund. He was just saying, based on the outcome, if it's positive, you pay me. Nice marketing tactic. I do that all the time off the record, but now it's legal because as a result of Ridgely, a practitioner may charge a contingent fee for an amended return. District Court found that Section 1027B of Circular 230 invalid as it pertains to refund claims and permanently enjoins the IRS from enforcing the regulation. So, the short version of this, the IRS says you can't charge contingency fees unless they lose in court. And we'll see when they update Circular 230, what it's really going to look like. Net, we can charge contingency fees on amended tax returns. And that's what the Ridgely v. Liu decision did. Got an interesting ethics situation. Believe it or not, this is all ethics because of Circular 230. This is a real case. I was doing it this year. Taxpayer's a serial non-filer. Spouse filed married filing separately every year. And she was doing what she was doing. Got a refund every year. She was a W-2 person. She took the kids. Practitioner brought the taxpayer into compliance. I did his last 6 years of returns, married filing separately. He owed $3,000 every year. He's self-employed. He didn't do, actually, he was doing estimated taxes, but not enough. In each of the last 3 open years, I amended to married filing jointly. The 3K balance due became a $500 refund. And so I did the first one, the one that was getting ready to go out of statute, and his $3,000 became a refund. And now I'm in the process of doing the other 2. Can I charge a contingency fee? Remember, I did his originals. My opinion is no, I can't charge a contingency fee because I was involved in the originals, in spite of the fact I had no intention at that time that I was actually going to amend the returns. So my take is we're just fine there, and I did not charge a contingency fee. Interesting question, and this is really deep into geekdom. If I can change his filing status from married filing separately to married filing jointly every year, why can't I go back more than 3 years? And the IRS code actually says you cannot change filing statuses after 3 years from the due date. And the due date does not include extension. So that's a bit of trivia. The other thing for you folks that go to tax court, obviously, sometimes we're defending SFRs. I often, when I'm with IRS appeals, will offer an amended return. I'll throw the wife and kids on there, and the settlement always comes back married filing separately. And I'm thinking, well, it's not that much of a deal. I'm not going to argue it. Turns out there is a code section that says if a notice of deficiency is received on a return, it is not allowed to change the filing status. And that's one of those, I always watched it, didn't know why it was happening. That's why it's happening. Here's something interesting, and we do have the poll open, so I will take a moment now so that you can make sure you can tell the computer you're on the call. And something interesting, we're using GoToWebinar. I can see the poll is open. I cannot see the poll itself. So apparently they're pretty convinced I'm still talking. So I will wait for a moment.
All right, you got 10 more seconds.
Yay, thank you, Mitch.
Nobody can say we didn't tell you about it.
I'm always happy to tell people about the polling questions in case they're doing emails or whatever else they might be doing.
Pay attention, everyone. All right, there you go.
Perfect. Okay, we're going to talk about the attestation on page 2 of a 2848. It turns out when you sign it on page 2, you're actually agreeing to be covered by the provisions of Circular 230, even if you're not a traditional Circular 230 person. You may not be an enrolled agent, a CPA, or a lawyer. And the question I just pose out there, and we may do this more in the Q&A section at the end, how binding is the signing of this Form 2848? If you have a civilian, let's say somebody that's settling his father's estate, and he signs a Form 2848, is the 2848 and Circular 230 binding only for that particular taxpayer that he had the POA on, or did he just sign up to be Circular 230 for the year, or what? Don't know the answer to that. But here is kind of a blown up page of the current Circular 2848. I'm subject to regulations contained in Circular 230, 31 CFR, Subtitle A, Part 10, as amended, governing practice before the Internal Revenue Service. And what I did is blew up that little code there. And you see who can obviously be applied. Circular 230 folks, attorney, certified public accountant, enrolled agent, and then furthermore, officer of a taxpayer organization, full-time employee of the taxpayer, a family member, an enrolled actuary, an unenrolled return preparer, and then you have all of the neat things, the student attorney or CPAs, typically they're working in low-income tax clinics, and an enrolled retirement plan agent, of which I think there's probably about 800 in the world. But interesting commentary. I'd be curious to get thoughts from you when we go to Q&A. Contingency fees for tax prep. Obviously, original return, no. Original return fee as a percent of the refunds, absolutely no, although the people in Miami haven't gotten that message yet. Yes on an amended return per Ridgely v. Liu. No original return to Trump and SFR. And yes on audit recon, because audit recon really is just kind of a form of an amended return. And I state, and not everybody may agree with me, but audit recon is eligible for contingency because it's a dispute to an unfavorable IRS ruling, typically a CP 2000 notice or an audit where the taxpayer did not respond to the audit notices. Are contingency fees for penalty abatement available? Yes, they are. And that's not because anything is in dispute, but because it is an administrative waiver that the IRS created in 2001 per IRM 20.1.1.3.6.1, last revised in August of 2014. You can also do contingency fees for penalties associated with an audit and obviously audit recon. First time abatement, IRS administrative waiver. It's available for abating penalties for failure to file, failure to pay, and failure to deposit, typically the 941 kind of stuff. And notice a little pound sign. Failure to file is available for 1040s, partnerships 1065s, corporations 1120, and 1120Ss, sub-Ss. We know through the School of Hard Knocks that when you call on a 990 and say, things got out of hand, it's all a volunteer organization, we didn't file the return on time last year, they'll say, great, write us a letter giving us compelling reason for you to qualify for first-time abatement, and we likely will abate that failure to file penalty. But 990 requires a letter. First-time abatement, we talk about this a lot. This is just a graphic showing that in 2007, taxpayer had a substitute for return, got hit with penalties for failure to file and failure to pay. But notice the prior 3 years, he was perfectly clean. He just fell off the wagon. He was into home remodeling, and with the downturn in the economy, he didn't know what to do. He couldn't pay somebody to do his taxes, and so he did what many of our clients do. They did nothing. They froze, and so he got stuck with that. And this particular case is kind of neat because he was in a full pay installment agreement, had about 3 years left on his installment agreement. His oldest daughter was starting college. I came along. This was actually my first-time abatement call that I made in 2014. I came along on the phone call. We knocked off over $7,000 of his balance because of the interest associated with this. And what that said is he was about 8 payments from paying it off. He paid it off in full and allowed him then to help his eldest daughter as she was beginning college. So truly, this one was a life-saving event. I did not do this one on contingency. I did this one just because I wanted to see if I could do it. Little background, since that point, I've been keeping track of it. In the last 24 months, I've abated more than $105,000 using first-time abatement in conjunction with contingency fees. And recently, we had reported to us the largest FTA that we know of to date. It was about $105,000. It was for a failure to deposit. And so we kind of keep track of this. If you're into clients that are doing big payrolls, and I've got a few of these people that rent employees, their payrolls are huge, and their 941 deposits on a quarterly basis are $1 million or more. We continue to watch these guys and they're not real good with their cash flow. So we watch these guys to see, in fact, are they going to qualify for first-time abatement? And then which one do they want to qualify for? It's kind of a silver bullet. You only get one per taxpayer. Let's talk for a moment about audit. I do huge amounts of audits, and my background, I'm not a tax geek. I'm a technology salesman for the past 30 years. So I'm always interested in the let's make a deal kind of thing. Here's one that actually happens. This is a real redacted situation. Completed a 1040 office audit for 3 years. Balance due was 55 grand, which triggered the 20% accuracy related penalty. That it's one of the 666s as LG talks about them. All of those penalties, the 2, the 3, the 4, the 5. Big penalty, 11 grand. And there is the numbers. You can see over here that for the period ended 2010, 2107, 2011, 4412, and 2012, 4497. Total is 11 grand. And I'm looking at that and I'm thinking, I know I can get that abated at tax court, but let's play games with these guys. So what I did is had this conversation while I'm sitting there. They gave me the 4549 report and said, here, look it over. Are you happy with it? Balance due was 55 grand. Penalty was 11 grand. I am unagreed at that point. Taxpayer had agreed that they would allow me to accept the audit and request penalty reduction at that point. They weren't at the audit. They authorized me to do that. Using the script on the following page, I abated the 11 grand penalty. And here was the script. We've done the best we can. We've given you all the receipts we have, and you've used them in your computations. We can't do any better because we don't have any more documentation. I will agree and sign the audit agreement today if you remove the accuracy-related penalties. If you don't, we'll just petition tax court, get them removed immediately in that venue. Let's save everybody time and money, remove the penalties today. Obviously, the auditor said no. I said, go check with your manager, see if we have a deal. Manager agreed. In less than 5 minutes, I abated $11,000 in penalties. How much was that worth to the taxpayer? I actually did this on contingency, and they were fine with it. And my commentary is, if you're doing an audit and you think you're going to be stuck with the collections, you want that final number to be as low as possible because it's going to make your life a lot easier in collections. I've seen some practitioners, they'll do the audit, and it is what it is. They don't even argue about the penalties because they're not getting paid anymore to fix the penalties. I submit to you that you might look at making your peer group aware that, in fact, they have the ability of abating those penalties and can actually get paid for doing it. I've actually started to grade other practitioners' audits. You can submit a FOIA and get copies of audit work papers for somebody that comes to you that was audited in the past and look at the final audit report. If there's accuracy-related penalties on that final report, the practitioner doing the audit may not have been advocating strongly for his client and obviously is not involved in the ensuing collection activity. There's also a scenario when not to dispute the audit penalties. And I've got one of these right now. Taxpayer plans to bankrupt against the entire audit deficiency, including the penalty. Net is, guy was audited locally by a terrible auditor who is not a very good bookkeeper. Basically, the guy had compelling documentation, but the auditor chose to disregard it all. And so the net of it is he has huge tax deficiencies on the order of $300,000. I looked at his compelling documentation, which wasn't all that compelling, and said, okay, here's the deal. I can get it down to 100.5, but you still don't have any money. You might want to talk to a bankruptcy attorney about bankrupting on this, if that makes sense for your point in life. And made him further aware that once his audit was done, he had to wait 240 days, about 8 months, after the audit assessments before the tax debts can be included in an audit. And right now we are in the 4th month of that 8-month pause. It's likely that he is going to employ bankruptcy as a means of getting rid of his tax debts. Here's another interesting thing, CP2000s. We all in the tax practice community see them. It is not an audit, but every client I've ever talked to said, I'm being audited by the IRS. they show me their CP 2000 letter. And in fact, the IRS computer is sending out 4 to 6 million of those a year. Roughly 50% of them are never answered. So it's a money machine for the IRS. It's really amazing. The posturing is correct for contingency fees because we have a dispute between the taxpayer and the IRS, and the contingency fees could be a percent of the savings. It's likely allowed, but it's questionable ethics. And I say likely, I'm not smart enough to know how the IRS would rule on that, but I do have an interesting example here. I had a CP 2000 taxpayer came to me. Taxpayer ignored all his letters, finally opened the final letter, notice of deficiency for a little over 900K. We said, hey, you want to petition tax court, which he did immediately. It's now docketed for tax court, and I've glanced at the data. He may end up with a refund. He is a house flipper. He does a lot of real estate. He was getting his return done at the third tier tax franchise company for $300 a year. He's doing a return that's got $3 million of income on it. And as I said, you got your money's worth for that $300. They didn't do it right. Now, the net of it is, okay, I'm pretty sure I can fix it just by showing basis on all the properties that he omitted from his return. Will Circular 230 allow us to charge a contingency fee? And here is the redacted 3219A. As you see there, notice a deficiency. Increase in tax 627, substantial tax understatement penalty, the 6662 for 125 grand, and the failure to file for 156 grand. And that is a very big number. What if I said, gee, I'll do it. If I'm successful, I will take 10% of what I save you. That becomes a very big number, doesn't it? And so 90 grand to do that. The real question, first question is that an unconscionable fee? In this case, it probably wouldn't be, because the guy is worldly. He knows what the hell's happening. He is very aware. And he also knows he doesn't want to owe the IRS almost $1 million. But in fact, I quoted him standard time and materials kind of thing. Hey, we're going to do an amended return. We got to make sure we know what the real answer is. I'm going to charge you my standard rate per hour. I'm going to go through all your closing statements. I'm going to show the basis on every one of the properties that was omitted on your return. I'm going to show the sell price. I'm going to show the costs associated with it. You may, in fact, have a greater loss, from all of this activity, and you may, in fact, end up with a refund. So that is my discussion on CP 2000s. Can we charge contingency fees? Well, it's kind of an audit. Some people would say yes. Some people would say no. I don't, but that's not to say I couldn't. Now let's talk about collections for a little while. Karen Hawkins has gone on record that collections is off limits, no contingency fees. So remember the 2-minute version of this presentation. The IRS says no to all contingency fees unless they've lost in court and unless there is a valid dispute kind of thing. Well, collections, there is no dispute. The money is owed. It's how you're going to pay or how are you going to try to resolve it. So somebody comes to you for wage garnishment, you can't charge a contingency fee, lien release, lien withdrawal, or reducing a payment on a partial payment installment agreement or an installment agreement. Wage garnishment is the one that really comes to mind. Somebody comes in, IRS is garnishing their pay. They've been doing it for the past 4 months. They can't buy gas to get to work, and they come in and say, I'm being garnished. Can you fix this? The answer is, of course. The next question is, how much will you charge me to fix that? And I'll give them a number. And then I'll say, and oh, by the way, can I have a retainer? And the guy laughs and says, I don't have any money. My wages are being garnished. So basically, I quote a fee, and I'm giving the guy payment terms. He can't obviously pay me today, but when his wage garnishment ends, he will take a little while to get on his feet. then he can pay me. So what I'm doing is I'm not giving him contingency fee. I'm not giving him a conditional fee. I'm giving him a fee with payment terms. And I think that is perfectly legal. Lawyers may choose to discuss that. So on collections, offer and compromise, it's really not the right venue, but consider what I've seen in some of the webinars. Some practitioners suggest the taxpayer put a tax prep representation fee of $100 a month to cover monitoring the account, make sure they stay in spec on their OIC, and preparing the tax returns for each year. That reduces the reasonable collection potential by $100 per month for a fee that had to be paid anyway. And oh, by the way, if that wasn't in as part of the OIC, the taxpayer would be paying that to the IRS. So here, they're actually getting some benefit for that money that they have to pay out anyway, and they're getting service for it. The practitioner is going to hold their feet to the fire, make sure that they're going to file timely, make sure that they're going to have a refund, and life is good. So a quick summary: contingency fee for tax prep, no on the original return. If you're in Miami, no, where the fee is a % of the refund. Yes on an amended return, no on an original return to trump an SFR, yes on audit recon. And here is the code section for contingency fees for penalty abatement, yes, and first-time abatement, yes, penalties associated with an audit, and yes on audit recon. I can see now I'm finishing a little early, so let me mention something else CP 2000 wise that I have discovered. Had a nice couple come in to see me a couple weeks ago. I'm in the state of Georgia. They gave me their letter. State of Georgia wants 10 grand from them. And they're showing me the letter and they say, we don't understand what happened. And so I did an 8821 on them to put my toe in the water. It matured in about 8 days and I pulled their transcripts. And lo and behold, what we found is they had CP 2000s for tax year 9 and 10. And the SFRs were pretty serious. They owed about 30 grand more per year. And since one is self-employed and one is W-2, not sure how the numbers are that high. Haven't looked at the returns yet or any of that. But I'm looking at it and I'm saying, okay, I know what happened. After a CP 2000 is resolved, and in fact, you then get your letter, notice of deficiency and all that. In the state of Georgia, you have 6 months to file an amended return. And when you file that amended return, then you then have an additional balance due to Georgia. If you do it within 6 months, and in fact, the state of Georgia actually has on their amended tax return a box that says amended due to an IRS audit. If you file within 6 months, you don't get penalized for filing this amended return. You're still going to pay interest, obviously, but that penalty for failure to file, if you will, is pretty steep. In Georgia, we have no statute. So, we always look at the CSED on federal returns. In Georgia, if I have balances due to the IRS, balances due to Georgia, Georgia never times out. I always suggest they're either going to pay Georgia off completely before and so they enter into an installment agreement with Georgia on a 433, a state tax payment deficiency is deemed as an allowable expense when in fact you are setting up your installment agreement for the Fed. So just kind of the way it works there. And it's an interesting topic. You could spend an hour on it, but the net of it is it's a great way of using transcripts to become a detective when somebody comes in and says, oh my God, I owe money to the state. I have no idea what's happening. And in this particular case, I went with my power of attorney over to the state of Georgia. I'm across the street, so I just walk over and do a compliance check. And they said, oh, by the way, they haven't filed 11, 12, 13, 14, or 15. And I reported that to the client, and they said, oh, have no idea what's happening. Our preparer has vanished off the face of the earth. So that will be some of my fall exercises, what I'll be playing with. So penalty abatement, absolutely yes. There is another poll that's open, so I will be quiet while you guys look at your poll.
And while you guys are finishing this, if you guys have any questions, go ahead and type them in the chat box now.
Okay, I think the poll is over. Is that correct, Mitch?
Yep.
Okay.
Yep, sure.
We'll just touch on this slide and then we're into Q&A. But penalty abatement, yes. Penalty associated with an audit, yes. Audit recon, yes. I gave this presentation 2 weeks ago. Happened to see one of the people that saw the presentation, and their commentary was, I was doing an audit. At the end of the audit, I had the accuracy-related penalties. I used your script. I saved 10 grand and 5 minutes. Thank you very much. So we do get feedback here. And the reason we do this, we want to share our experiences and our tax knowledge with other tax professionals. And with that, I finished a little early, as I told Mitch I would. And he was saying, you're not going to finish 30 minutes early, are you? And I said, no, it won't be anything that bad.
No, we can work with 8 minutes. Actually, I could probably answer. Well, you could probably answer about 75% of the questions with just the one. They're all pretty much the same. So basically, there's a lot of people who are interested in knowing the logistics of how to actually collect the contingency fee. You know, most people are not so trustworthy of our clients.
I'll answer it how I do it. I play the percentages. You know, I know that 9 out of 10 people are going to pay me, and they all have problems. I think as an enrolled agent, it's my duty to help everybody that's honest that comes in the door with a tax problem. And most of them are going to pay me. And I share a phrase with them that they kind of blink when I say, and I say, you know, you're going to owe me some money. And you know, the last person in the world you want to have angry at you is me, because I hold your IRS future in my hands. So I'm sure you'll pay me. And most people kind of hear that. And the other thing I say, because I've done a power of attorney, I know where you live. Interesting contingency kind of thing. Some practitioners, for whatever reason, have not been paid. And so you'll see on the chat boxes, can I send them a 1099-C, cancellation of debt? And the answer is yes, but it's illegal. It's a violation of Circular 230. And because you're not in the business of loaning people money, you are not authorized by the IRS to send a 1099-C to a taxpayer. But let's look at it on the face value. Can I send, not should I, can I send a 1099-C to a taxpayer who hasn't paid me? And the answer is, of course you can. You are violating Circular 230 when you do so, but of course you can do that. And you can also stick a collection agency on them. You can do anything you want. You can even sue them in small claims court. It's up to you. It's a business proposition. Okay, Mitch, another question?
All right, so another one is it okay for, Jody was saying that she had a client who the year before went to one of the chain tax preparation places, and they charged a percentage of the refund. Is that something that's acceptable?
We know people are out there doing it. It is a violation of Circular 230. That particular preparer likely is covered under Circular 230 either because they have initials after their name or they have signed a power of attorney. It comes down to this. It's rather interesting. IRS says everybody that does returns for compensation has to have a P10. But they never said what happens if you don't get a P10. And the real answer, we've done some research on this and we've watched some court cases. The IRS has no jurisdiction on a preparer if they do not have a P10. They're not part of the system, and the IRS cannot touch them. And there's a couple court cases. They happen to be disbarred lawyers who were doing tax returns. They weren't a lawyer anymore. They did not have a P10. They were doing tax returns and doing rather bad tax returns, fraudulent. IRS couldn't touch them because they weren't in the system. That just kind of an oh by the way that frustrates the heck out of OPR, but it's happening every day. We happen to have one of these in Georgia. A gal was doing fraudulent returns for years for policemen and for EMTs and so on. She started to get some notoriety. IRS couldn't touch her. She said she was an enrolled agent. I looked her up. She wasn't an enrolled agent. I happen to have the full P10 list for the for the world. She didn't have a P10 either. And so the IRS couldn't touch her. Georgia couldn't touch her because she was outside the system. They arrested her for stealing money from a family member, and she's now awaiting trial. But they couldn't touch her for doing fraudulent returns because she wasn't part of the system. Aren't we in an interesting business?
Yeah, we are.
Yeah.
All right, let's do another one here. So this is Jeff, and he's asking, he focuses a lot of his practice on federal tax liens, and he's asking, is OPR's opinion that since the tax isn't disputed, they believe that the filing of a federal tax lien can't be disputed, therefore no contingency fee to defend a federal tax lien withdrawal?
Excellent question. Okay, yeah. Typically, when you're in collections, the IRS is saying there is no controversy. His comment was the IRS has filed a federal tax lien, and now they've created a controversy because perhaps his taxpayer is in the financial services business. If he has a tax lien on his record, he will lose his ability to do financial transactions as a broker or whatever. I think at this point a dispute exists because the dispute is you're putting the taxpayer out of business if you don't remove that lien. Is it something you can charge a contingency fee for? The real question, OPR would say no. I would say yes, personally. And that's another one of those you'd probably have, I'm going to charge you this much money. I know you don't have the money now, but when you do, you'll pay me. So, excellent question. There will be two answers, yes and no.
All right. So let's do a couple more. We have a couple more minutes here. So do you have any kind of guidelines on the percentage of contingency that you charge for the cases?
It turns out Circular 230 precludes me from telling you what my price list is, unless it's published. But I will tell you that in general, I have seen people on first-time abatement, if there is a first-time abatement achievement, that you're successful. If the taxpayer owes no debt and has paid money to the IRS in the past 2 years, and you solicit first-time abatement, they will get a refund. I have seen tax professionals say, I will do this for 20% of the refund. So that's one business model. The other business model, taxpayer has outstanding debt, and this happens all the time. The best place to go for first-time abatement is collections. Those guys tend to be far more generous, and I have had first-time abatements on a telephone call while I'm setting up an installment agreement of over 15 grand, which is kind of cool. So what you're doing there is actually reducing the tax due or reducing the monthly payment on an installment agreement. Some practitioners are charging 10% for the savings in that regard. So if you get money back for the taxpayer, we've seen people charging 20%. If you're just reducing their tax liability, 10%. But obviously, it's whatever the market will bear. If somebody's in hard collection with the IRS, they probably don't have a lot of spare money available. So the practical realities merge into what the market will bear.
All right, so 2 more quick questions. The first one is, if you find out that another preparer is charging fees, do you have a responsibility to report them to OPR?
Excellent question. And the interesting answer is, somebody showing you a tax return or something, yes, you can, but you are violating the 7614 or whatever it is, the disclosure, because you're disclosing information you're not authorized to disclose to the IRS. So Bianna Whitlock's scenario is, it's 7216. If in fact you report another preparer who is doing bad things, you've actually violated 7216 by reporting him, because you've got the taxpayer involved. And so the net of it is, the IRS has got this wonderful form that you can fill out to report bad behavior on another preparer, but in doing so, you are revealing the name and information of the client, and so you're in violation of the disclosure part of the IRS code.
All right, cool. All right, let's do just one last one. It has to do with the states. So do all the states follow Circular 230, or do they have their own guidelines? How would someone figure out what to do for their state?
I think in the main of the 40 states that have income tax and income tax code and so on, relatively few of them don't have their own embellishments on the tax code. I think many of them will use Circular 230 as a baseline, but a lot of them, for Georgia, for example, I can't find anything with regard to how a preparer in Georgia is supposed to run their business. And so I think it's an implicit Circular 230. I happen to be on the Georgia DOR Taxpayer Practitioner Liaison Committee. So I'm not just anybody. I've asked the question of some pretty high ups there, and the answer is we don't have anything in writing. So excellent question.
All right, well, we've gotten our 50 minutes, so I think we're all set. Thank you so much, Bill, for your time and taking your time out to do this presentation. I think it went very well. I think we answered the majority of everybody's questions. We will send out the certificates on Monday. So like I said before, please, when you get them on Monday, just print them out and keep them for your records. If you're an EA or you gave us your pizza number, we're going to submit all those credits directly to the IRS for you, so you don't have to worry about that. And that's it. Thank you guys all for coming and spending some time with us today. And actually, Roger Nemeth is going to be doing our presentation next month, so we'll give you, I think that's going to be on CSED dates and things like that. So we'll send out some more information next week, probably about the date and time for that. So thank you guys, everyone, for coming, and we'll see you next month. Thanks, Bill.
Thank you so much. I enjoyed it. Bye-bye now.